Objectives of an audit. Objectives of an audit, that is the area that you can do a recap on. So the first one is that it is there to enable an auditor. The objective is to enable an auditor to express an audit opinion or conclusion on the subject matter or financial statement. That is one objective audit, to enable the audit to give conclusion on the financial statement. That is number one. Number two, the objective of audit, apart from giving an auditor an opportunity to give a conclusion or an opinion, is also to give an auditor an opportunity to express his view on the financial statements, whether the audit is actually free and fair, or whether the audit is quite reasonable. The financial statements are reasonably prepared, that represent the free and fairness of the financial statements. Remember that expressing a conclusion or coming up with a conclusion whether financial statements represent true and fair view is different from giving an opinion or whether the audit that was qualified or unqualified. But both of them are the objectives of audit. So the first one is to give an auditor an opportunity or a chance to give a conclusion on whether financial statement represent true and fair view, company's position, or is free from material misstatement. And the other one is also to enable the auditor to give an opinion on the audit report, whether qualified, unqualified, or adverse. The other objective is also to enable the auditor to gather enough evidence to conclude or come up with a conclusion. To enable the auditor to gather enough evidence to come up with a conclusion. Now, let's look at the stages of audit. Just a summary, stages of audit. So we normally have the first stage of an audit, that is audit planning. Of course, there is what we call acceptance of engagement, but that is not acceptance of engagement. That is the first one. The second one, planning. The third one, execution. Then the fourth one, we have a review and conclusion. Then we have reporting. These are the stages in audit. Those are the stages in audit. Kindly remind your colleagues that classes have started so that they can join. Kindly call them. I don't want to leave them far. The audit that we normally do is called statutory audit. But then we also have audits that are not statutory. Statutory audits are audits that are required by the law, state, from the word state. But the opposite of that are called individual audits. They can be called private or individual audits. These are the ones that somebody just does because he wants them, right, for personal need. Now, the advantage of audit might not just be because it is a statutory requirement. It is even intending to help the owners of the bookkeep or the bookkeepers. So one of the advantages of audit is that it gives assurance on the credibility of the financial statements. It assures you how the financial statements look like. It can also be used to acquire loan or credit facilities. That is also another advantage of audit. So as you check or as you look at them, they are not basically for the purpose of statutory requirements, but it can also help you even if it was just for private use. To get loan, to assure you on credibility, you can also do audit so that you can purchase the property. Whenever you want to purchase a property, you normally call somebody to come and give you the financial statements so that you can look at them. It also helps to detect errors. It can also be able to use, it can be used for tax purposes to file return. So disadvantage in Kwamba, it is expensive for some people to do audit, and it's also time consuming, right? The audit can also be, can also bring conflicts, right? Can also bring conflicts because if there is any error that was included by the auditor, then it gives a wrong impression. So it can cause some conflicts when you're doing audit. So those are areas that, again, you need to pay attention on. Responsibility of the auditor, I've talked about that. Then we talk, I want us to now look at something called quality review. Quality review. Now, remember when we talked about review, we are talking about, we have types of review. Where we have hot review, we have cold review, we have peer review. So again, you need to prepare yourself with these ones. So basically, hot review are the ones that are done concurrently with the audit process. The audit is going on, but concurrently, a review is being done. Cold review is normally done after the audit process. Then we have peer review being done by a professional with the same skills or knowledge as the person who has, the accountant who has done the audit. Now, review is normally done so that you can be able to ensure that there is quality in terms of the audit work that has been done. Basically, mtu anapitia ihakikishe it is of the right quality. So when we talk about the quality control, one of the quality controls that we have is a review. It ensures that there is quality in the audit. We also have training. We also have following ethical standards. We also have things like leadership. Those are part of quality controls. In audit, quality controls can be ensured by ensuring that review is done on the job. So proper supervision, training, having the right team or qualified team, but also the partners or the directors also need to ensure that they have the good tone, or they give a good example by ensuring that there is quality in their work. Also, other ethical standards like the independency, integrity, objectivity also ensure that there is quality. So what are some of the roles of the quality reviewer? The person who is reviewing the quality of the audit. Roles of the quality reviewer. Roles of the quality reviewer. Number one, the quality reviewer needs to be able to have a discussion with the management to understand, or the engagement partner to understand the scope of the assignment. When you're going to review somebody's work, you need to have understood what are some of the areas that needs to be covered. So the scope of the assignment or the scope of the work that you're reviewing is very important. So the quality reviewer needs to have an engagement or a discussion with the audit partner to understand the scope. So that is one role of the quality reviewer. Number two, you need to check whether the client and the team that have done the audit are independent of each other. That is also another role. Kazi yake ni kuangalia that there was a full independence. Also, they need to check that the working papers that are there actually reflect the work that was performed during audit. The working papers are basically the files that were compiled. You need to check that they actually represent the work that was being done, right? So that is another role of quality reviewer, to analyze or to evaluate or check that, ensure that the working papers selected for review reflect the works that were performed. Another review is that you need to be able to check whether significant risks were identified and they were addressed appropriately by the audit team. That is another one. When the auditor was performing the work, he should have identified some risks. Those risks should have been addressed appropriately by the team and discussed with the management. Also, he needs to check that the judgment that was made or the conclusion that was arrived at by the auditor were actually were arrived at with respect to the materiality of the risks that were identified. That means that when you're coming to conclusion, you should have based your conclusion on the risks that were identified. So those are some of the roles of the quality reviewer. They are just people who are trying to check and ensure that the work that you've done is actually of quality. Now, let's look at another area, the types of the types of audits that we normally have around, sometimes they set some very, very simple questions like types of audit. So you can look at the types of audit just as a reminder. Types and classification of audit. Audits are classified, or the types of audits are in certain classification. For example, we can have final versus interim audit. Those are two types, but we're looking at them in terms of the period. At what time are they being done? So we have final versus interim audit. So what are some of the final audits that you know? Final audit is normally done at the end of the financial year, but the interim audit is normally done in the mid of the year, right? That is before the end of the financial year. So when you talk about the final audit, then of course you need to know that in most cases, final audit is the one that is required by law to be done. Interim audit is not a mandatory requirement. Hello? So there was an exam that was set in some of the last papers. They were asking for the activities that should be undertaken during interim audit and final audit. Like now this one, they are saying that explain the objective of an external audit. External audit. So when you talk about external audit, again, that is another category of who is doing the audit. So we normally have independent audit, which is also the same as external audit, and we have internal audit. So what are some of the objectives of external audit? Whatever the question that has been given to you in the case study doesn't matter that much. What is important is that you understand the importance or the objectives of external audit. Like this one, external audit are basically they are being done by external auditors, and the objective is to enhance or to improve in terms of the credibility of the audit. Also, to protect the interests of the third parties. That is why we call external auditors, so that they can protect our interests as third parties. Also, to give a level of confidence by assuring us on the position of the company, whether they really represent true and fair view position of the company. Another one, they can also be used to access loan. They can also be used to access loan. They can also be used to detect and prevent errors. They can be used to detect and prevent errors or frauds. Those are some of the objectives why or the aim of external audit. Then here we have procedures to be undertaken during interim audit of an entity. 5 audit procedures to be undertaken, and then they were also asking for the procedures during final audit. So is there a difference between the procedures in final audit and in interim audit? So during interim audit, normally interim audit is done before final audit, right? So that means that interim audit will try to do some things that are done at the first time when you start auditing. Mara ya kwanza ukianza audit, zile vitu inafaa ufanye ndio inafaa kufanya wakati wa interim. For example, you can be trying to understand the organizational nature of business. You will understand the level of or the structure of the organization, the risk assessment. Those are things that you can do during interim, so that at the end, during final, you don't need to come and ask for them again. Because there is no way you do interim, then you end up asking for the same information during final audit. There's no way you can do interim, then at the end of final audit, you come again and ask for the nature of business. You want to understand the organizational structure, the composition of the company, maybe the customers, the nature of business. It doesn't make sense, because those are things that you should have known when you are doing interim. Otherwise, ulikuwa unafanya nini kwa interim kama hauelewi haukuelewa kampuni ile kazi inafanya. So that is those are some of the activities that you do during interim. Number 1 is to understand the internal controls within the company. Number 2, the nature of the business or background of the business, integrity of the management. You can be able to do that. Also hierarchy in terms of decision making, who are supposed to make decisions in the organization, the industry in which the organization operates, and also maybe the regulatory environment. Who are the regulatory environment, or what is the regulatory environment where the company operates? And maybe the top management, the top governance, the audit committee team, the structure, such kind of things can be done at that time. Also, you might be able to look at the analytical review procedures, where you will be able to perform analytical review from the last audited account or opening balances analysis. So opening balances analysis are supposed to be done during interim, because at the final stage, during final audit, you don't do opening balance analysis, but you're now doing a closing balance analysis, where you can be able to interpret the performance of the company. At that stage, you can also be able to understand the scope of your audit work during interim. You can be able to understand the risk exposures and the scope. You perform risk analysis at that particular level. And also at that time, you can be able to plan for the final audit. You can be able to know what are some of the substantive tests that I can wait and do during final audit. Now, those are some of the things that you can do during interim. At the final level, maybe you can now do going concern assumptions, because at that time, that is when the board of directors are now giving their own conclusion about the going concern assumption. You're looking at the subsequent events that can affect the company. You're doing the final review or substantive tests and review. You're doing watching for transactions that happens after the interim. You're trying to check the transactions that happen after an interim at that level. You might also test on the compliance test on the regulatory requirements. Maybe there are ratios that the company needs to have met at the end of the financial year. So that is the time now to do test and confirm whether the ratios are matching what the regulators requires. Those are some of the things that you can be able to perform. Maybe you can also do check on the accounting policies, right? And the assumptions that have been used. Maybe company depreciation, they normally depreciate at the end of the year. You can perform again and check the depreciation, how they have been treated. So those are things that you don't need to do. You can actually do at the end of the period. Those are some of the things that you can be able to do at the end of the period. Now, on that note, we talked about interim audit. You now know when it's done, right? We also have continuous audit. That is another one. Continuous audit are the ones that are done throughout the period, throughout the year. There is no end. So continuous audit is where an audit is engaged to the client throughout the accounting period. So what are some of the advantages of continuous audit? It is normally good with a large company where transactions are so many, so the errors can be detected on time. That is one advantage. Number two, it facilitates the completion of final audit. Inafanya final audit, kumaliza final audit inakuwa rahisi. That is another advantage of interim audit. But also, the presence of the auditor through the year makes the client accountants attentive. The account staffs or the clients, basically, the staffs will be attentive. They will not misbehave because they know the auditor is there throughout the year. That is another advantage of doing that. So that also can help. Okay, so another one is that it reduces time that will be spent during final audit. That is also another advantage. So let's look at the next question. I just want to do a rough review on areas that can be set or what they normally look at. So what are some of the drawbacks of conducting an interim audit? Interim audit always interfere with the client, because the client, every time you do audit, they have to adjust some things or stop operation to wait for you. So it brings, sometimes it interferes with the client operations. It is also expensive sometimes. It also increases the workload of audit staff, because they have to do audit now and again another time, instead of waiting and just do it once. So some people feel like going there 2 times is also difficult. But there is also a possibility that the client can also alter figures when you have done an audit, so alteration for figures. Now we have other types like final audit. It is a statutory requirements. It is good to meet statutory requirements. It also gives you the figures that you can use to file returns. That is also another advantage when it is done at the end of the year, right? It also gives an auditor an opportunity to give a conclusion on the report. Remember, in interim audit, the auditor doesn't give conclusion or opinion. That is only given on the final audit. Now, we also have others like procedural audit. Basically, you're trying to check the procedures that the auditor uses to make that the client uses to operate. So you need to identify the outdated procedures, the ones that need to be replaced, and the ones that are according to the current procedure manuals. Then we also have management audit. You're basically trying to look at the efficiency of the management, whether they are very efficient in their operations. It's called operation audit. So we have joint audit. Joint audit is when you are doing audit with two different firms. This is where there are more than one audit firm are doing audit. So you are doing audit as a team. So what are some of the advantages of doing audit as a team, joint audit? So when audit firms are doing audit together, the advantage is that they are able to share knowledge. They are also sharing risk. They are sharing knowledge. They are sharing risk. They are saving resources because the resources are going to be shared. That is another advantage of joint audit. Another advantage is that apart from sharing knowledge, sharing resources, sharing risk, they can also do what? What are some of the advantages? They can also share cultures so that you can be able to learn from each other what others are doing in terms of the cultures and beliefs. Those are also there. Then we have forensic audit. So forensic audit is normally done to gather information or to give a report that is intended to be used for court proceeding. So the main aim of forensic audit is basically to gather a report and evidence that can be used in court proceeding as part of the evidences in court. Then we have a group audit. Group audit is when you're auditing group of accounts, group of companies. That is both you're auditing the parent, the subsidiary, and the associate. Now, in some cases, in group audit, you might find that the companies that are doing audit or firms that are doing audit are of different partners. They have different experience. They have ages of experience are quite different. So you find that the group or the group auditor, that is auditor of the parent company, is called group auditor. Parent company is called group auditor. Sometimes when you are being told that you now have to compile and sign the report of the components. So components are like subsidiary. So you have to compile the report for the parent and the components like subsidiary, associate, then you sign, you're the group auditor. One of the worries that you might have is that if where the components are being audited by a different firm, you're not very sure about the risk. What are some of this? What is the scope? What are the risks that they are exposing you to? And then the knowledge. So you'll be asked an exam. You might be asked an exam about group audit. What will be some of the risks or some of the factors to consider before accepting the work to work as a group auditor? You are going to sign the report that have been done by other people, the subsidiary auditors. You are going to compile and sign. So the risk, number one, is that you are not able to understand the skills. You don't know the skills that these people have, the experience, number one. Number two, you don't know the scope. You don't know the assumptions that they made. You don't know the sampling criteria. You don't know the evidence, whether they have sufficient evidence. Such kind of things can make you not become comfortable signing the report as the group auditor. So those are some of the reasons why they might not be able to do that. Then now, we also have operational audit. That is, I know that plan you understand. It's about auditing the operations. We are looking at the efficiency and the effectiveness of the operations. Now, what are some of the advantages of internal audits? So internal auditors are actually auditors who are part of the management. They are part of the employees of a company. So what is the advantages of having internal audit? It is an ongoing review. So that means that you are able to detect errors mapema because you keep on checking. And number two, it also improves in the performance of management. Management can get advices from these guys and improve. It also ensures that there is better use of resources, no misuse of resources, but people are also, there is also delegation or division of labor, such that people have separate responsibilities, which ensures that there is control. So it is also part of the control measures. The problem is that getting the staffs who are qualified, who understand that job is not easy. So the first challenge is shortage of qualified staff, the time that they are going to spend sometimes. People see that they are actually interfering with the accounting process because they have to delay you to do audit. Some challenges are like management are ignorant. They don't see the importance of this team, so they are not able to allocate resources because of their ignorance. So that is basically the other ones. I think you can be able to maneuver with. I don't think there is any question that you can set about topic number one that is quite tricky. Sampling criteria is something that they like setting, sampling criteria. Now, in audit, you can either use judgmental sampling or what is called statistical sampling. Judgmental sampling is where you are judging, you decide and make decision on which samples to pick. But in statistical sampling, you can use random sampling or any criteria that gives uniformity on the chances of every item to be picked from the population. So every item has got equal opportunity or chance to be picked. So in judgmental sampling, it is the one that is mostly used in audit, because in audit, you need to know which are the areas of high risk. Then you make your own judgment that I need to check this and not this other one. So it is normally good because it saves time. It makes you focus on areas of high risk. It can also help you to know how much evidence you need for each item. It's also good when it's applied in areas where the population is not homogeneous. The population or the items that are being audited are not the same. So you can't pick sample and you think that it represents the whole population. When you are using statistical, you just pick any and assuming that they represent the whole population. You just pick blindly. But unasema hii kama it represent the whole population. So you apply judgmental where samples are not the same, where characteristics or features of the samples are not the same. Statistical, maybe you can be able to use where samples are the same, they are very the same, and there is low risk. Because any that you pick, there is no risk that it could give you a wrong conclusion, ama kuna zingine umeacha, inafaa uangalie. So again, samplings might be a set. Another area that they can set is about value for money audit. Value for money audit. So normally we have 3 E's of value for money audit that you need to always remember. And value for money audit is almost the same as public sector audit. In most government programs or projects, they are actually not after making profit, but after seeing that people are getting value. The same to NGOs, the same to NGOs. So value for money audit is just basically to check or ensure that the investors are getting value for their money. The investors are getting money for their money, or the government, the wananchi are getting value for their money. So value for money audit has got, it is the same as public sector audit, because in public we don't make profit, we're just looking at whether the money is being spent well. So value for money audit, they normally write like this: VMF, VFM, value for money, then audit. It has got some 3 E's. In value for money audit, there are 3 E's. The first E is efficiency. Then we have economy. Then we have effectiveness. So effectiveness basically means that the results of your actions can be seen. Yeah, whatever you're doing, people can see the result. Matokeo inaonekana, right? So that is effectiveness. People can see the benefit, they can see the result of whatever you're doing. So that means that if you are spending money on the project, but at least we want to see the project going on. See ati pesa inakunywa tu, lakini inaenda hivyo. We want to see the results. That is effectiveness. Then economy, that means that the cost of starting the project or the cost of money that is invested should be the lowest compared to the market. It should be cheaper, or at least you spend less to start the project or to run the project. But then we also have efficiency. Efficiency is about ensuring that the cost of running that project is lower, not the cost of starting, not the cost of investment, but the cost of maintenance and running the project is actually cheaper. So if somebody is saying that machine is very efficient, what does that mean? That that machine consumes less fuel. The machine can be expensive. It was not economical when you buy it, but when you are running it, it is now cheaper. So value for money audit, the 3 E's are very important, and they can ask that in exam. So you need to check how, in terms of efficiency, you need to look at how the process and the systems are run. They should be efficient. And then in terms of economy, the cost of acquiring and also distributing the resources should be cheaper. Then we have limitations of audit. Why do people feel like even though we are doing audit, it does not meet the required expectation? And in the same way, they can ask you that audit function has been something that audit is something that has been in demand for some times. So what are some of the reasons why there is a growing demand for audit? If you are asked about that, mbona watu wanataka audit siku hizi? Number one, because of the complexity of transactions. Transactions zimekuwa mingi na ni ngumu kuelewa. So we need experts to come and do for us. Number two, we need audit because we are far from the subject matter. Maybe I've invested in Nairobi, but I stay in UK. So I'm very far, I can't be able to see what is happening, right? So because of that, I need somebody who can do that on my behalf. That is also another one, because of the proximity between the owners of the subject matter and the subject matter itself. The item that is being audited and the owners are quite far from each other. Number two, because of lack of knowledge. Even if you are there, but you don't have the right knowledge to audit, then that is also not helping. So because of lack of knowledge, we need people who are expertise to do for us audit. Then some reasons also, maybe we do audit because of biasness in information. If you were to leave managers to give us the information about the report or about the audit or about the financials, they will give us information that only pleases them. So because we expect them, they can be biased in terms of the information that they're giving us. We need a third party to come in and check for us to verify and tell us whether those information represent true and fair position of the company. Otherwise, the management can be biased. So we are saying that the biasness on the side of management also now make us call somebody to come and audit. So and then now we also have some risk as a result of technology. A lot of technologies are coming in, some cyber theft, frauds can also make us call for audit. Now, those are some of the reasons why there is demand for audit. Those are some of the reasons why we have demand for audit. Now, some of the inherent limitations of audit, some of the challenges that comes with audit, which we call inherent limitations. There are challenges that comes with audit, inherent limitations. Of audit. One of them is that judgment on financial reporting. The fact that we are judging is a one limitation, judgment. And these are why we cannot give absolute or 100% level of confidence. We can't give absolute assurance, but we give a reasonable assurance because the audit itself is not complete. It's not 100% perfect. The first one is because judgment. Whenever human being is giving judgment, they sometimes become biased. Then sampling-based auditing, we do sample or watching sampling-based auditing. That is also another challenge that we do sampling. The other challenge is that management responsibility. Management responsibility. So management responsibility, sometimes management can give auditors information that are not complete. It is their responsibility to give you complete information. Lakini kama auditor, wanakupea information, but that information is not full. How will you know? Sometimes you might not even know that there are information that are not full. For example, the management can actually go and open bank account somewhere. They are doing business, but the revenues goes there, right? In cash, for example. How will you know? How will you know? If they did tell you that they have another bank account, and they can even have it there, they get money from that bank account, they buy land, they have plots, they have some rental buildings, they get more money, but you never know that there is another revenue that's coming in, right? Then also the possibility of fraud when there is collusion. Fraud can happen when there is collusion. When there is collusion, it is not easy to detect because there will be proper documentations, everybody will sign, the right people. So unless you have some hint that we have some collusion, it is not very easy to. Okay, so we are saying that whenever there is collusion, then again, the audit will not be effective because proper documentations will be done, the right people will sign, so you will not see any gap. Then the next one is because of limited times that we have. We don't have enough time to do audit. So sometimes we might not be able to exhaustively perform the audit. Those are challenges that we face. Now that is topic number one, which I didn't cover. In most of my revisions, I've not done that very well. So I just decided to go through it again. Now topic number two is about assurance and non-assurance engagement. That one I've done several times. The types of assurance, elements of assurance engagement, reasonable assurance. We have limited assurance. We also have attestation engagement and direct reporting. Go and look at those. So in that topic number two, the areas that they normally set, elements of assurance engagement, examples of assurance engagement. They also ask maybe the difference between review and audit engagements. They also ask about the types of assurance engagement, not examples. So the types of assurance engagement, that is where students normally have problems. Maybe I can just go through that very fast. That when you talk about the types of assurance engagement, we have them classified into hazard assurance level. You say that assurance engagement are normally classified under two categories. The first one is hazard assurance level. So under this, we have types. The first one is called reasonable assurance. And then the second one, we have limited assurance. Now, reasonable assurance, that means that the scope is unlimited scope. Low risk, low audit risk. Then we have high confidence level. High confidence level. We have positive form of opinion. And when you talk about positive form of opinion, we are talking about an opinion where the auditor was able to perform the work exhaustively and is able to give the conclusion with confidence. Positive form of opinion, that means that the auditor was able to have sufficient audit evidence. He was able to have sufficient audit evidence And so he can come up with a good conclusion. And that conclusion will be in the form of the opinion that is given. And he will say that, in my opinion, the financial statement represents true and fair view. So positive form of opinion, I'm repeating again, is where the auditor was able to have sufficient audit evidence. Now, these are some of the features of reasonable assurance. The example here is audit engagement. In audit engagement, the fact that I've said that it is positive doesn't mean that it's a good audit or a good report. It could be positive, but it is going to have the opinion. This is why the auditor can give the opinion. In positive, it can give the 4 opinions that we talked about. The first opinion is normally unqualified opinion. We also have adverse or a qualified opinion, which is not very good. It's also called except for. Then we have adverse opinion. Then we have the last one called disclaimer. Now, in these ones, the auditor has got evidence to give this report. So, in audit engagement, that is the only engagement where you can give conclusion. In review engagement, you can't give conclusion because you are not able to come up with a good report. You are not having enough evidence. So you can't review and then you give a conclusion that they were unqualified. Because these ones are only given in statutory audit. Audit that is done at the end of the year, and the auditor is able to have sufficient evidence to support his conclusion or opinion. Now, so example of reasonable assurance I've given you, that's where we have audit assurance. Now we have the second type of assurance that is called limited. Limited is quite different from this. It is the opposite. Number one, we say that in this one there is limitation in terms of the scope, limited scope. There is high risk, low level of confidence. Examples are negative opinion. Example is like review engagement. So that is another type of audit, but you have first to classify under that. So these are 2 types that are classified under that. We have some other 2 types that are classified under assertion level. Is that assertion level? Here we have 2 types. The first type is called assertion or called attestation. They are the same, attestation or assertion. This is where the auditor, in this particular type of assurance or engagement, in this one, the auditor does not perform the audit activities. It is the responsible party of the management that performs the audit activities. He collects the evidence, he evaluates the evidence, he writes the report. The only work of the auditor is to give information or give his opinion on the reliability of the information that has been given to him. Mtu anafanya kazi, wewe kazi yako ni kupeana conclusion, whether they are reliable or not. That is called attestation engagement. But under direct engagement, that is number 2, is the auditor that is directly involved in this particular. It's also called direct reporting. Direct reporting. The auditor is the one who is directly involved in the collections of the evidence, analysis of the evidence, and even reporting and giving the conclusion. So he's directly involved in everything. So that means that we can have a different engagement like that. One of these could be maybe something like we can have something like in compilation report. Compilation report. This is where the auditor doesn't have to give a conclusion. Not compilation technique. Example here is a review engagement. because somebody else does it, so your work is only to go through it, to complete here. So review engagement is one of them. This one is audit. Actual audit is being directly done by the auditor. So direct audit. So those are examples. Here we have the review being at the station. Here we have review here, then audit here. Here audit is in this one. Now, if you are asked about the types of audit, don't start giving examples of assurance engagement. Example of assurance engagement. Assurance engagements are where the auditors are not expected to give any conflict. Assurance engagements are where the auditor, assurance engagement are where the auditor is expected to give a conclusion that it is intended to enhance the level of confidence. So again, in example, I can ask you to differentiate between the two. Just make sure that you go through the same so that you can be able to write the differences between assurance engagement and non-assurance. Then look at the examples of assurance engagement and non-assurance. Let's come to topic number 3. Topic number 3, just roughly. So topic number 3 is about ethical consideration. I believe professional ethical consideration. So in that area, they normally ask about the ethical standards. And you need to know them, the ethical standards, the confidentiality, objectivity, and then competency, independency, integrity, and professional behavior. They look at the factors that can affect them, or factors that can hinder that. Things like surface, self-interest, self-review, right? Intimidation. We also have advocacy threats, such kind of things. Then, how do we reduce those particular threats, to ethical standards? So those surface are the threats. Surface are the threats to ethical standard. So how do we reduce them? That is one area that they normally set. After that, the other area they normally set is about the auditor's responsibility, where they can ask you, who are the auditors responsible to? The third parties, the three parties. Number one, the audit the client under the law of contract, the third party under the law of tort, and the state under criminal and civil laws. And you can be able to explain how the auditor can actually find himself in criminal liability under the criminal law. Number one, when he actually collude with the client to commit fraud or some criminal activities, when he tried to intervene or advocate for the client, when client has done something that is wrong, but is trying to advocate or support the client position, when he's trying to intercept or prevent the client from being arrested, by maybe an feature information zingine your client asishikwe. Those are some of the things that you can do. Also, maybe when he knows that the client has done a mistake, but he's not giving that information to the relevant authority. When he also practiced as an auditor, when he was not approved to do so, then that is also a mistake or a criminal offense. And so, in terms of the liability, there is in terms of the third-party liability and the client's liability, it is normally under the law of negligence. The auditor can be liable to the third party and the client under negligence, meaning that he has failed to do something that he was expected to do. For example, he failed to use the right audit procedures, and so that can actually put him on trouble. So I again told you some of the ways in which the auditor can actually be able to take himself away from that particular scenario. I said that he has to prove that he didn't have any due care, he didn't have any duty to take care of, or there was no relationship between the loss suffered and the liability. You go and look at those things, that lack of duty of care or negligence is not related to the loss suffered. The loss suffered is not quantifiable. You didn't owe the client any liability. Then elements of assurance engagement, don't forget about them. There are only 5. Number one, three-party relationship, suitable criteria, appropriate subject matter, then sufficient and appropriate audit evidence, or basically evidence, sufficient and appropriate evidence. Then the last one is reporting. Now, the suitable criteria must be relevant, right? It has to be relevant. These are the characteristics of suitable criteria. When we talk about suitable criteria, characteristics of suitable criteria. Suitable criteria is basically the standard that is being used, right, in audit. The standard. So that standard should, number one, be complete itself. What do we mean? For example, if it is a policy, it should be a policy that makes sense and has been approved. If it is not approved, then it is not complete. So you cannot use, for example, the operation policies or HR policies. You cannot evaluate how HR is performing with a policy that has not been fully implemented or has not been endorsed, has not been signed by the right people. So that means that that policy is not complete. If it is law against the law, if that law is still pending, it has not been approved by the parliament, then it is not a complete criteria. So the completeness of the criteria, that means that the criteria has been prepared in accordance with the relevant requirements, and actually it is actually expected to be effective or it is implementable. Then that criteria should also be relevant. It has to be relevant with the subject matter. The criteria must be relevant. There must be correlation between the criteria and the subject matter. You can't use a standard for HR to check on how the financial standards are reported. Reporting, or maybe you're using credit policies to check whether the HR has been performing their work well. There is no relevance between the HR policy and the credit issues. So that means that there must be correlation or closeness between the standard and the subject matter. So it has to be relevant. And the next one is that it should be neutral. It should be neutral. So that the standard should be applied uniformly. See, ikifika kwa branch manager A, you're using a different standard from branch manager B. That is being biased. So the standard should be applicable everywhere. And the standard should be understandable to everyone. The person being evaluated should be able to understand the standard. It should be understandable. The standard should be understandable to the person or the responsible party. Not that you're being audited, but you don't know the criteria that you're using. When you finance manager, how do you that you're supposed to use certain standard? So in a far, ikuwe standard that we pia unaelewa, lakini haukufanya vile inatakikana, right? So those are some of the things that you need to look at when you talk about this particular standard. So we talk about that, and maybe the last one is we talk about reliability. Reliability is the last one. Okay, so we talked about reporting. We talked about topic number 1, topic number 8, which is reporting. We talked about topic number 3, topic number 2. Maybe we go to internal controls. Those are areas that again they normally set. Internal controls. So maybe any other thing here about what could be said, the internal controls I can see they were setting here. Inherent risk, this one I've just explained about audit opinion. The threats to independency, this one I've talked about. What else? Let me just explain to you about internal control, and then we can now wind up, because those are the key areas that we normally set in exam. There is also this term that they normally like setting or bring in exam called lowballing. Lowballing. So lowballing is basically a situation where the auditor is quoting a low audit fee so that you can actually get the job. Unasema ile pesa kadogo angalau upate hiyo kazi, right? That is called lowballing. It's when the auditor is quoting a small audit fee in order to get the job. So this one is also risky. They can ask in exam, what are some of the reasons why lowballing is not a good thing? When you set a small audit fee, then sometimes you are not able to perform the job because it is not enough for you. It is not sufficient enough for you to be able to perform the job. So those are some of the challenges. Utafika mahali unakwama juu hauna pesa ya kuendelea na kazi. So that is challenging when you are putting lowballing. So internal control system. That is an area that they normally set. And I can assure you that what we have just revised now, at least 50% itakuja kwa mtihani or something that is related to them. There's nothing they said that is quite unique. Just need to go and revise and revise and revise what we've been doing in class, and you'll be good. So internal control system. So internal control systems are basically the procedures and policies that are put in place by the auditor so that they can be able to, by the client, sorry. There are policies and procedures put in place by the client or management or a company so that they can be able to achieve their main objective. Of course, the objective of doing business, number one, is to make profit, and number two, to reduce risk. That is the first objective. They reduce risk and to make profit. Now, if we are putting some policies and procedures, then we need to understand which kind of policies and procedures are these. So we have controls that are normally put in place. These controls can be physical and also non-physical. The controls can be physical and non-physical. So under physical controls, non-physical are basically system-based. And then we have physical. Can somebody tell me some of the physical controls that we know around? Physical controls. Physical controls that you know. Physical controls in an organization, kama gani? Surely, am I talking alone? You guys are there? Physical controls. So internal control activities, some are physical, like watchmen. We normally have watchmen, we have CCTV, right? We have keys that are locked. Those are physical controls. But we also have other controls, like number one, segregation of duties. Segregation of duties, those are controls. We have authorization and approval. Those are also controls. We have having organizational structure. That is also control. We also have reviews and reconciliation. Those are also controls. We have security systems. Some are within the system. When you're logging into the laptop or your desktop, they are normally password. Those are controls. Some of the weaknesses of having controls, like especially the system controls, is that we normally believe that those controls are okay. So you normally assume that there is no need to look at those things keenly. So the system could have been hacked, but you're not even aware. We assume that the systems should be working well. Another disadvantage that we have is the resources that is spent on it. They are very costly to spend money on them. Then also it requires skills. Some of them require skills to be used so that you can be able to use them, like system controls. The things that we are putting in, like maybe you put firewall, you put antivirus, you put some strong password. Illiterate people might not be able to understand that, The other one is about faulty in terms of judgment, that you assume that they are very okay, so you don't need to look at them. Faulty in terms of judgment. But again, system also depend on the errors. If there was an error when it was being prepared, like kama ni antivirus, ikitengenezwa vibaya, then you depend on it kumbe haifanyi kazi, right? Or maybe we have controls like maybe firewall, somebody has not actually done it well. Then you are there waiting that it could be good. Kumbe, it was having some human errors when it was being prepared. Now, those are some of the mistakes that we can also find in those issues with control. What else can they bring? Now, let's look at the elements of control or components of internal control systems. That is another area that they like setting components of internal control system. Internal control system is also called ICS, and the components are normally acronym is CRIME. So the first one is control environment. We have risk assessment. We have information and communication. We have monitoring and evaluation. Then we have existing control activities. Existing control activities. Those are part of the components of internal control system. Components of internal control system. So at least I've talked about limitations of internal controls. Those ones, at least if they ask an exam, because I can see they asked it, it was asked in which year? Limitations of internal control. In April 2021, they were asking the components of internal control and then limitations of internal controls. Those ones, at least now, you are okay with it. Because we talked about human error, that one is there. Then also, people now don't take responsibility. They believe that the system can work well. The procedure can also fail because of the way it was done. The controls might not be very good. There is also cost element of it, cost element of on those controls. Then I want us to look at control environment, and that will be the last thing. So we talked about control environment. Control environment are basically the tone. So what we are saying is that for internal controls to work well, then these ones should be tested. You need to check that number one, the environment where I want to put the control is actually conducive. People are able to understand and accept that control. Number two, that you are able to understand the types of risk. The risk assessment involves identifying the risk, evaluating that particular risk, looking at the factors that can cause that risk and how it can be prevented. So you need to first identify the risk exposures. You need to judge which types of risks are there and what are their impacts, where are the sources of those risks or what brings them and how can they be prevented. And then you look at the management response to those risks. Some of the response are, right, management response to risk are response to risk. We have risk taker. We have risk averse. We have risk neutral. Those are part of the risk appetite. Those are part of the risk appetite that we normally have. So the management can decide to retain the risk. They can take the risk, right? They can defer the risk, like they move it somewhere else. They can also avoid the risk. So the response depends on the management's appetite. So what basically matters is that you're able to explain what risk assessment is, identification, classification of those risks, and maybe coming up with the risk response. Those are the most important things. And then we have information and communication. This is about the information that is being collected. How does the organization pass the information that they have? That is information and communication. Then we have monitoring and evaluation. That how you are basically trying to monitor how the controls that already are put in place are working. The controls that we have in place, how they are working. Existing controls are basically trying to check on how the current controls that we have in place work. Then let me look at the last part, which is the control environment, components of control environment. Now, when we talk about control environment, it is different from internal control. It is a component of internal control, but it also has its own components. So we have components of control environment. Components of control environment. Number one, the components of control environment. Number one, we have manage integrity and ethical values. Management integrity and ethical values. Because I say that control environment is the tone in the organization. So the first one is the integrity and ethical values. We also have commitment to competencies, organizational structure, philosophy and operating styles of management, philosophy and operating style of the management, human resource policies and practices, human resource policies and practices, organizational structure, operational philosophy and operation of the management, operation style of the management, then participation of the management, So those are basically the control environment. So don't confuse components of control environment with the components of internal control system. Don't confuse them. So I think we can stop from there unless there is any question. Do you have any question?